Hello everybody, Randy Patrick here. Time for Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Wednesday, the 21st of August. We're going to have a shorter video today, pretty much just me yakking about the most important news that came out today. And my first comment is stop drinking the Kool-Aid. What we're going to talk about today should be enough to, I guess, people who still think we're in an appreciating market's great, things aren't going to change. This is a telltale sign. And I think if you're still drinking the Kool-Aid, you got to check where your sources are and figure out where the numbers are going these days in the real estate market. So when I first look at the first piece of information this morning, or later this morning, it says the rise of existing home sales. When you hear headlines like this, you would think that things are going good. We're rising, everything's great. Well, the point today is that NAR, which is National Association of Realtors, released their existing home sales report for July. And did it increase or rise? Yes, it did. Did it rise by a lot? No, it didn't. And I'll talk about that in a second. But I want to qualify this because if you recall, back earlier in the year, which is maybe January, February, people were always asking questions. It's part of my video, my discussion as to where the housing market's going, where do you see prices headed, et cetera, et cetera. So what we've seen since that first part of the year till now, we've seen month over month, we've seen some inventory coming on. We have seen sales volume slowing down. We've seen price, we'll call it price deceleration or decelerating appreciation. So every month, the year-over-year price appreciation is getting less and less and less. That's happening, and everything is trending downwards. So I'm going to tell you right now what NAR is basically telling us today is that existing home sales climbed 2.5% in July compared to June, so a slight uptick in the month. Now, going back to my previous videos earlier in the year, one of the comments I made was we're seeing sliding and erosion all the way through, and I'm very clear about this, saying that we're going to see probably an uptick in the summer months because it's the seasonality of it all. People buy and sell homes. They want to relocate and move during that time frame, go to a new city, new part of town. You get your kids signed up for school. You want to get closing. Typically in July and August is where everything happens. Different parts of the country, we've already started school. We started school here last week, so that kind of season's over for us. Other parts of the U.S., school is Labor Day, time frame or just after Labor Day, so maybe we'll see some activity in August. But I want to be clear here saying that, I was very upfront saying we will probably see a small uptick in the summer months, and we are. Now, get this though, 2.5% climb is from June to July, but if you want to go year over year from July 2018 to July 2019, sales are up just 0.6%. So we're really seeing nothing material here. We see a little bit of June, we see a little bit more, little uptick from year over year in July, and that's kind of it. That's all we got going here. Now, if you trend back a couple months ago, when you talk about, I guess pending home sales, well, if pending home sales are dropping, that's foretelling closings in the next few months. So I know we've had pending home sales drop, and we're going to see, and that's continuing to drop, and we're going to see that as well too. So our friend Bubble Kitty just happened to pop on today, and she's going to endorse what I'm saying here right now. But again, now Realtor.com or National Association of Realtors, Lawrence Yun, who's the economist dude there, chief economical officer, basically said falling mortgage rates are improving as housing affordability are nudging buyers into the market. So really, you've got mortgage rates that are helping to push buyers in to a certain point, but we know a lot of buyers are not actually jumping with respect to some purchase applications we'll talk about in a second. So again, month over month, the existing sales are up 2.5%. Year over year, it's only up 0.6%, which to me is a pretty telling number, you could say right here. And I'm going to get rid of this little one. Okay, little one, off you go. There she goes. All right. So that's a scoop on that. If you want to look regionally what has happened, actually even before that, home price appreciation has been much stronger in the lower price tiers compared to the upper price tiers. So basically, they were sort of looking at going, if you purchased your home around the 2012 mark, which typically is the trough. That's, we went up 2006, we troughed, and we're up 2019 now. So if you bought in the trough, the 2012 area time frame, you've done pretty well on your home if you've actually sold it. They say some locations, they increases of Atlanta area 165%, Colorado area, Denver 103%, Miami 119%, Tampa, my area 125%. So yeah, if you purchased at the low point and you sold now at the high point, you're doing okay. There's no doubt about that. But again, sales are still slowing down as far as I'm concerned. If you look at regional breakdowns here, July, the Northeast decreased 2.9%. The Midwest edged up 1.6%. South increased 1.8%. And the number one area that actually increased would have been existing home sales in the West shot up 8.3%. So the West basically had a much better increase, and I know that's probably because they've had a lot more, I guess you could say, extremes decrease in prices and more inventory coming in the market. So that's a scoop for that. So when I go to my charts here, I look at the market conditions of what's happened. So existing home sales by region, 43% of sales were in the South, 23 in the Midwest, 22 in the West, and 12 in the Northeast. So you can see how it's skewed to certain areas. When we look at the percent change in sales from a year ago by price range, the issue is that the sub $250,000 market gets hit the most. So obviously, the 0 to 100K, the change is negative 10%. The 100 to 250K, the change is negative 0.6%. That's the change in sales. So the reason being because the affordable housing. So those segments are seeing less and less sales every month, whereas the 250 to 500, 500 to 750K, 750K to a million and 1 million plus are all showing 12%, 13%, 8.5%, 7% increases. So there's movement happening, but where people need homes the most, the movement's actually decreasing. So there's less and less sales supporting that marketplace, which brings us all back to the whole point with respect to distressed housing and where we can find inventory. It's tough to find inventory out there right now. There's places we can look, or you can look if you want to, but people just don't bother. So that's kind of the scoop. Again, existing home sales percent change year over year. So we've been dropping. So we've dropped 17 months, and this is the first month where we actually had an increase in the first and 17 months we've had a sales increase, so 0.6%. So again, that's good news, but from what everybody was touting with low interest rates, and again that tagline, despite low interest rates. So if we're still drinking the Kool-Aid about the interest rates, well, why don't we see greater sales despite low interest rates? Why don't we see more home sales activity despite low interest rates? Why are we not seeing more pending sales? Why are there's so many things that are going on despite low interest rates. The home sales are not just there, which interest rates, I think we've solved the problem that that's not the main problem. Sure, you're going to bring in a few more extra buyers because it's a little more attractive, but that's not the main driver, which we've talked about many times here. And when I go to look at market conditions as well too, so you want to take a look at the July sort of distribution. Well, first-time home buyers, 32% were first-time home buyers, about the same as a year before. Sales to investors, about 11%, down a point from the year before. Cash sales, 19%, down a point from the year before. Distressed sales were at 2%, down a point from the year before. Distressed sales, of course, is made up of short sales and REO, bank-owned properties being sold via the MLS. Want to clarify this, so everything that we talk about here is MLS-based sales. So of course, National Association of Realtors pull all the MLSs across the board and do their statistics. So this does not include off-market sales and things like that. So please be aware of that information. To summarize, existing home sales for July 2019, median price point was actually $280,000, 800. That's a small increase from this time last year. And we take a look at inventory. So total housing inventory in the July decreased to 4.2 months supply at the current pace, down from 4.4 months in June and 4.3 months supply from this time a year ago. That's kind of the scoop on that. So again, it boils down to there's not enough inventory out there. That's why you're still going to see some increases in median price. However, we're not seeing people coming out in droves to purchase property. We're not seeing July being a 5% or 10% year-over-year increase in sales, not even a percent. So 0.6% year-over-year to me is not very material at all. And I think that's kind of telling. And that's my point here. So I was thinking that we're going to see probably in that 2 to 4 range year over year, and we're off that basis. So to me, the market's anemic, and that just shows that, I think we're, when you couple that with, price, decelerating appreciation, some more inventory in different locations, homes on the days on the market longer, all these things are pointing to further slides as time goes on. And again, this is a peak month. To me, July is one of the premium months where deals close, and you can see what activity is going on. So keep that in mind. All right, a couple other things here. Interesting to sort of tie into that. This is from Housing Wire. So are mortgage lenders maxed out? NBA survey shows, NBA's Mortgage Bankers Association survey shows refinances at a 3-year high. So the point is here, do mortgage lenders have their hands full right now thanks to the recent surge in refinances? Looks like that might be the case. Overall, mortgage applications actually fell slightly last week, but the decline came entirely from purchase applications. So there you go. So more, the MBA, Mortgage Bankers Association, is tracking weekly applications, and mortgage applications are potential contracts for potential closings down the road. Well, it's been sliding for how many weeks now, and they keep dropping. If we look at, according to the MBA report, approximately 63% of all the mortgage applications received in the last week were for refinances. That's the highest the refinance share has been in almost 3 years. So despite lower rates, this is the one time where lower rates make sense for people. So every time rates drop, there's, I think I mentioned this before, there's always a report where somebody comes out and says, okay, now, we've, 5 more million people can refinance their home because of the reduction in rates. That's based on loan to value and things like that. So again, it's interesting to see that. But so my point though, so when you have, the majority, the lion's share of applications being refinances, to me, that's another telltale sign for the future. And that means all these people who are refinancing probably are not putting their home on the marketplace. They may feel that, in my opinion, they may feel the market's topped out. They're probably not going to get the sales price they want, or will be on the market for longer than they wish. So maybe we'll just take our money out right now. That's how I kind of read into at least part of that. 63% of refinance is that people are choosing not to sell. If you take a look at the refinance activity, so refinance share almost 63% increase from the previous week. Adjustable rate mortgages increased to 6.4% of all applications. FHA's share of mortgage apps rose 9.7% from last week's 9.5%. The Veterans Affairs applications actually dropped about half a point from last week, and that's really kind of it. So they're just sort of, they talk about where the average rates are. So the average FHA backed rate is 3.87 amount. So 3.87%. So which is still pretty good. But the point though is that we're just seeing less and less purchase mortgages. So again, critical time frame, I actually thought we were going to see a little bigger uptick, and we didn't. So to me, that's, from what I want to see happen in the marketplace, a good sign. So people aren't jumping on these homes anymore. People are waiting, and again, despite lower interest rates. So again, if you're still drinking the Kool-Aid, I don't know where the market can go, because once September hits, we see less sales. We may see more inventory come in the market. If that's the case, we're going to see price decreases. So again, we're kind of at we're at where we should be peaking right now, and we're not peaking. That's the point here. So, and keep in line with that, just the last little bit here. Oh, and by the way, so I haven't even mentioned this yet. So I always appreciate the views, the comments, the likes, and the shares. If you're interested in real estate news and like to know what's really going on from someone who tells it like it is with no real agenda, that's me. Please do me a favor and subscribe to my channel. Thank you very much. And last but not least here, we have a guy named Steve Eisman. I don't know if you've heard of him before, but he is sort of famous. The movie The Big Short was done sort of based on his, I guess you say, betting against the subprime mortgage market back in the last housing crisis. And so they profited wildly because he made the right bet when the mortgage market sort of took a tank in the last housing crisis. Well, he was interviewed on CNBC, and he was looking at Zillow as sort of like a I guess you could say an investment opportunity. And it says Eisman, famed for shorting subprime, explains why he's betting against Zillow. And he says currently Zillow is his largest short. And he's not talking short sales, he's talking shorting the stocks and that capacity. So I know there's the term short selling in stocks and short selling in real estate, and the two are very different things. So he's talking short selling in the stock, so he's betting against the stock, you know what I mean? So he basically said that Zillow has one of the most flawed business models he's ever seen in a very, very long time. And the part I find the most problematic is what they call, I believe, their iHome business, their internet buying business, where they actually go out and buy homes and flip them. I actually think the company doesn't understand the real risks of this business, which are massive. So that's an interesting point he's making here. There are thousands of mini markets across the US. They're all local. They're all extremely different. They all have incredibly different risks. And this is a capital intensive business. I only know one thing for certain: between now and 5 years from now, assuming the company has some level of success, there'll be massive problems that they will uncover. I'm sure there'll be write-downs, I'm sure there'll be impairments, and I'm convinced that the investor base doesn't have a clue about what this business is really about. Because Zillow has to get its money from someplace, right? So it's going to its investors to buy and sell these homes. And we all know that, you know, the home flipping business and, you know, the fix and flip business needs to kind of work in an appreciating market, or you're buying homes at a really, really deep discount. So I don't know whether Zillow is able to buy them at a discount and turn them for a profit. We'll have to see. But I think it's interesting though that you know, he's shorting their stock. And it's his largest short, and that's what he likes to do. It's how he makes his money. So he thinks this is a very risky proposition. This is just Zillow. Whether he believes this for other iBuyers, I honestly don't know, because it wasn't mentioned here. But I'd have to think that, you know, some of the iBuyer modeling may be sort of critical, or he could be critical of it, or it could bear some resemblance to Zillow as well too. But again, Zillow's trying to be all and everything, right? The be all and all. You know, offer you mortgages, do your closings, buy your house, get you a new house they already have in their inventory. So, you know, there's a lot of things going on at this company, and you know, I think Zillow's probably the first place people go to look up their home value and to see what's going on in the local marketplace. So that's kind of it with respect to Zillow. I just think it's kind of funny that, you know, the guy who pretty much, you know, I guess you could say bet against the subprime is now betting against Zillow. So I think that's kind of interesting. Clearly he knows what he's doing. So that's a scoop for today. I didn't want to make this an overly long video. I just thought it was pertinent to get it out today. And again, I'm not trying to toot my own horn here, but what I'm saying, because I read most of the comments, and I know some people just think I don't know what I'm talking about. And you're entitled to your own opinion as I'm entitled to mine. But my point is, we didn't see a major uptick or even a significant uptick in July's existing home sales. So they were you know, underwhelmed. We're going to see spins saying, oh, existing home sales increased. Well, you know, again, you know, 0.6% is not that material as far as I'm concerned, but I'm sure it'll be played out like, hey, everything's great in the marketplace and things are changing. You know, decelerating appreciations here. You know, as time goes on, we're going to see less and less of that happening. This is a premium month for home sales and value upticks, and we're not seeing it right now. We got one more month that's going to be diluted here in August already, so we'll see what happens in the future. So that's kind of it, everybody. Oh, and having said that, I know that I'm still trying to get back to people for my Never Pay retail sort of products. So if you want to get in on that, this is, you know, I'm going to go through stuff like this. I'm going to show you why distressed properties are great deals, how to get your hands on them, how to blend retail buying with some investor concepts to help you get the best price possible. So I do know I've had a busy week this week. I do know that you know, I need to get back to people, but I want to make a push to get everybody who wants to be in the beta program by the end of the week, and we can get moving on it, because I've done some work on the back, some more work on the background and the behind the scenes and the modules this past week. So I want to get more information and requests from people so we can get that going. So if you want to reach out to me, please do so. Let's see if we can tie everything up by end of the week. And just as another just sideline comment here, the number the number of people inquiring regarding distressed property has increased the past couple weeks as well too. So when we take a look at, you know, where the market's going, a lot of people you know, are looking at the next wave of when things are going to drop and looking for support opportunities, where to buy, how to buy, etc. So my inquiries have gone up quite a bit. I'm just stating as a fact that there's a lot of sentiment out there, and everybody I meet and I talk to seems to feel that, you know, they can kind of feel the market's changing, and you know, everyone's preparing for what's going to happen towards the end of the year in early 2020. So if you're not prepared, or at least looking to inquire and figure out how to navigate through that, I suggest you start reading and doing more due diligence, or give me a shout and we'll see what happens. But again, a lot more people are sort of thinking of this, and which to me means I'm not the only one that thinks we're going to have some changes in the real estate marketplace coming up shortly. So having said that, again, appreciate the views. Appreciate the likes and comments. Reach out to me for your housing needs. I know I've helped a lot of you already, and I hope to help some more people. Engage me if you want to talk about learning about real estate and how to either invest or just how to save money in your home purchase. And again, if you're not already a subscriber, please support our channel and subscribe. I would really appreciate that. So anyway, guys, thanks very much. We'll look forward to talking to you before the end of the week.